All right, let's move on. The annual ordinary general meeting of the South African Reserve Bank, or the Sarb, was held on Wednesday, where the governor, Tuesday, where the governor, Leseja Kyangango, spoke to the changes on the board of the central bank and touched on recent monetary policies and the overall economy. Let's listen.
Inflation remains a major policy concern for central banks globally. Although global inflation declined from 8.7% in 2022 to 6.8% in 2023 and continues to ease in 2024, it remains high relative to the 2 to 3% inflation targets that many countries are trying to achieve. Restrictive monetary policy, along with the recovery in supply chains and other pandemic-related bottlenecks, has helped inflation to recede from its 2022 highs. However, global disinflation has slowed recently, as is well illustrated by consumer price inflation in the United States, still sitting at 3% relative to their 2% target. The slow pace of disinflation reflects a pattern of lower imported inflation, but higher services inflation across most economies. In sum, rising wages and sustained pent-up demand for services has been key factors. In emerging markets specifically, fiscal challenges and sustained currency depreciations have played more of a role. Policy commitment to reduce inflation back to targets has been strongly signaled around the globe, and central banks have generally been cautious in their approach to policy. Deepening geo-economic fragmentation, higher temperatures, and other supply-related risks raise concerns about the long-term prospects for inflation, and considerable effort is going into assessments of neutral real rate levels. While inflation remains higher than desired, global economic activity has proven to be more resilient than expected. Global growth surprised higher at 3.3% in 2023, despite considerable divergence in growth across individual economies. Generally, however, global growth rates are expected to remain below pre-pandemic trends. This reflects the impact of protectionist measures on global trade, relatively tight financial conditions, as well as uncertainty of future policy trajectory. Greater stability in global affairs and more sustainable fiscal policy settings across the G20 countries would help to dampen uncertainty and enable longer-term horizons for policymakers, firms, and households. While lowering debt levels weigh on growth in the short term, the longer-term effects of falling borrowing costs act to improve growth prospects, supporting private investment and freeing up fiscal space. Lower inflation would also open monetary policy space and support easier credit conditions complementing the fiscal actions. The Sarb forecasts trading partner growth to remain moderate in the medium term, hovering around 3%. On the domestic front, despite varied sectoral performances, output in the South African economy slowed to 0.7% in 2023 from 1.9% in 2022 and remains well below growth in peer emerging market countries. Load shedding and logistical challenges have been weighing heavily on economic activity, depressing the credit appetite of businesses and the spending of households. Despite such weak growth in output, however, employment levels have recovered the 2.2 million jobs lost during the height of the pandemic. As of the first quarter of this year, total employment levels surpassed its 2019 level. Nonetheless, job creation has been too slow and not enough to offset the growth in the labor force, leaving the unemployment rate elevated at 32.9% in the first quarter of this year. South Africa's tailwind for growth coming from strong terms of trade continued to fade, despite still remaining at historically good levels. Exports also suffered over the past 12 months from energy and logistics challenges as much as price factors. Imports were also muted by logistics. As energy and logistics constraints continue to ease, the growth outlook will also improve. The domestic economy is expected to grow by 1.1% this year, rising to 1.7% by 2026, as both household spending and investment start to strengthen.